여러분, 은행을 살려야 나라가 살고 나라가 살아야 국민이 산다는 논리로 우리가 IMF 외환위기 때 소위 나라사랑 금목이라는 명목으로 국가와 기업과 은행의 잘못을 온 국민이 대신 수습하느라 분주했던 경험이 있잖아요. 아이슬란드에도 총리가 우리가 위기 극복 방안으로 국민들이 은행 채무를 분담해서 갚자는 주장을 펼치게 됩니다. 그런데 결과적으로 아이슬란드 사람들은 그걸 곧이곧대로 듣지 않고 엄청난 반항을 했고요. 결론적으로는 금융위기 발생 및 관리 소홀의 혐의가 있던 은행가와 정치가 등 90여 명이 법원에 기소되고 은행의 빚을 국민이 분담해서 갚자고 주장하던 총리는 2012년 4월 같은 혐의로 유죄를 선고받죠. 제가 오늘 보여드리고 싶은 것은 2008년도에 거의 비슷한 경제위기를 겪은 아이슬란드와 미국의 180도 다른 대처 방안에 대해서 보여드리고 싶었는데요. 그래서 금권정치의 문제점에 대해서 다시 한번 여러분들에게 상기시키고 싶었습니다. 반면에 2008년도 금융위기를 해결하기 위해서 뽑힌 오바마 대통령은요, 수많은 수백만 명의 국민들이 집을 잃게 되고, 정말 경제적인 어려움에 허덕이는데도 그들에게 도움을 주지 않고, 단 한 명도, 처벌을 받지 않았습니다. 그 잘못을 한 기업, 은행, 정부조차도 처벌을 받지 않았고요. 최근에 보니까 2021년도에 140억짜리 맨션을 샀더라고요, 오바마가. 저 예전 그 방송 보면 우리가 다 함께 잘 살 수 있을까 하는 그 스웨덴 편에 보면 타게 에를란데르라고 제가 아주 존경하는 정치인이 있는데, 그분은 23년간 통치를 하고 스스로 하야했을 때 노부부에게 살 집이 없었다고 합니다. 그래서 많은 스웨덴 국민들의 마음을 울렸는데요. 여러분, 가끔 왜 미국에 도널드 트럼프 같은 사람이 대통령이 됐을까 좀 신기하잖아요. 그런데 그게 그 민주당에 등을 돌리기 시작한 게 오바마 시기에 오바마가 대중들의 손을 들어줬다기보다는 그 월스트리트의 그런 꼭두각시 노릇을 잘한 거죠. 왜냐하면 선거 때 그들에게 돈을 엄청 많이 받아서 그럴 수밖에 없었지 않았나? 저는 그렇게 생각을 하고요. 그리고 아이슬란드는 보면 오히려 국민들을 위해서 복지를 더 키워서 그 위기를 극복할 수 있었습니다. 어떻게 두 나라가 극명하게 다르게 그 사태를 받아들이고 해결을 했는지 여러분들에게 보여드리겠습니다. 오늘은 정말 중요한 영상이니까 꼭 좀 끝까지 봐주시기 바랍니다. 그리고 좋은 영상이라고 생각하시면 많이 공유 부탁드릴게요. 여러분 이제 미국 편을 한번 보실까요? 참, 오바마는 여기 이제 뒤쪽에 나옵니다. 오바마는 최근에 이제 제가 엄청나게 비싼 집을 샀다고 했잖아요. 근데 그분 또 최근에 또 유명인들을 모아놓고 얼마 전에 광란에 또 생일 파티를 해서 또 구설수에 올랐죠. 그리고 이번에 그 조 바이든 대통령 아무것도 근본적으로 바꾸지 않겠다라고 스스로 꼭두각시를 자청했던 조 바이든을 뒤에서 배후에서 밀어줘서 버니 샌더스가 이기고 있었는데 그 상황을 역전시키는데 굉장히 계략을 펼친 대통령입니다. 전 대통령이었죠. 뭐 그거 얘기하자면 길지만 어쨌든 미국이 어떻게 똑같은 비슷한 상황을 대처했는지 한번 여러분들 금권정치의 최고봉이라고 해야 되나? 아니면 사실 뭐 최고가 너무 많아서 최고라고 할 수 없지만 한번 보시기 바랍니다.
The regulators didn't do their job. They had the power to do every case that I made when I was state attorney general. They just didn't want to.
September 2008, the bankruptcy of the U.S. investment bank Lehman Brothers and the collapse of the world's largest insurance company, AIG, triggered a global financial crisis. This crisis was not an accident. It was caused by an out-of-control industry. Since the 1980s, the rise of the U.S. financial sector has led to a series of increasingly severe financial crises. Each crisis has caused more damage, while the industry has made more and more money. After the Great Depression, the United States had 40 years of economic growth without a single financial crisis. The financial industry was tightly regulated. Most regular banks were local businesses, and they were prohibited from speculating with depositors' savings. In 1981, President Ronald Reagan chose as Treasury Secretary the CEO of the investment bank Merrill Lynch, Donald Regan. The Reagan administration, supported by economists and financial lobbyists, started a 30-year period of financial deregulation. In 1982, the Reagan administration deregulated savings and loan companies, allowing them to make risky investments with their depositors' money. By the end of the decade, hundreds of savings and loan companies had failed. This crisis cost taxpayers $124 billion and cost many people their life savings.
It may be the biggest bank heist in our history.
Thousands of savings and loan executives went to jail for looting their companies. One of the most extreme cases was Charles Keating. In 1985, when federal regulators began investigating him, Keating hired an economist named Alan Greenspan. In this letter to regulators, Greenspan praised Keating's sound business plans and expertise and said he saw no risk in allowing Keating to invest his customers' money. Keating reportedly paid Greenspan $40,000. Charles Keating went to prison shortly afterwards. As for Alan Greenspan, President Reagan appointed him chairman of America's central bank, the Federal Reserve. Greenspan was reappointed by Presidents Clinton and George W. Bush. During the Clinton administration, deregulation continued under Greenspan, and Treasury Secretaries Robert Rubin, the former CEO of the investment bank Goldman Sachs, and Larry Summers, a Harvard economics professor.
The financial sector, Wall Street being powerful, having lobbies, having lots of money, step by step captured the political system, both on the Democratic and the Republican side.
By the late 1990s, the financial sector had consolidated into a few gigantic firms, each of them so large that their failure could threaten the whole system. And the Clinton administration helped them grow even larger.
Since the end of the Cold War, a lot of former physicists, mathematicians decided to apply their skills not on Cold War technology, but on financial markets. And together with investment bankers and hedge funds,
Creating different weapons.
Absolutely, as Warren Buffett said, weapons of mass destruction.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
that it will be possible to move this year on legislation that in a suitable way goes to create legal certainty for OTC derivatives.
I wish to associate myself with all of the remarks of Secretary Summers.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives. By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong. In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings. Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.
Real estate is real. They can see their asset. They can live in their asset. They can rent out their asset.
Through the Home Ownership and Equity Protection Act, the Federal Reserve Board had broad authority to regulate the mortgage industry. But Fed Chairman Alan Greenspan refused to use it. The ratio between borrowed money and the bank's own money was called leverage. The more the banks borrowed, the higher their leverage. In 2004, Henry Paulson, the CEO of Goldman Sachs, helped lobby the Securities and Exchange Commission to relax limits on leverage, allowing the banks to sharply increase their borrowing. In 2005, Raghuram Rajan, then the chief economist of the International Monetary Fund, delivered a paper at the annual Jackson Hole Symposium, the most elite banking conference in the world.
Who is in the audience?
It was, I guess, the central bankers of the world, ranging from Mr. Greenspan himself, Ben Bernanke, Larry Summers was there, Tim Geithner was there. The title of the paper was essentially, "Is Financial Development Making the World Riskier?" And the conclusion was, it is.
Rajan's paper focused on incentive structures that generated huge cash bonuses based on short-term profits, but which imposed no penalties for later losses. Rajan argued that these incentives encouraged bankers to take risks that might eventually destroy their own firms, or even the entire financial system.
It's very easy to generate performance by taking on more risk. And so what you need to do is compensate for risk-adjusted performance. Summers was vocal. He basically thought that I was criticizing the change in the financial world and was worried about regulation which would reverse this whole change. So essentially he accused me of being a Luddite. he wanted to make sure that we didn't bring in a whole new set of regulations to constrain the financial sector at that point.
Goldman Sachs sold at least $3.1 billion worth of these toxic CDOs in the first half of 2006. The CEO of Goldman Sachs at this time was Henry Paulson, the highest paid CEO on Wall Street.
Good morning, welcome to the White House. I'm pleased to announce that I will nominate Henry Paulson to be the Secretary of the Treasury. He's a lifetime of business experience. He has an intimate knowledge of financial markets. He's earned a reputation for candor and integrity.
The article came out in October of 2007. Already a third of the mortgages defaulted. Now, most of them are gone.
One group that had purchased these now worthless securities was the Public Employees Retirement System of Mississippi, which provides monthly benefits to over 80,000 retirees. They lost millions of dollars and are now suing Goldman Sachs. By late 2006, Goldman had taken things a step further. It didn't just sell toxic CDOs. It started actively betting against them at the same time it was telling customers that they were high-quality investments. By purchasing credit default swaps from AIG, Goldman could bet against CDOs it didn't own and get paid when the CDOs failed. Goldman Sachs bought at least $22 billion of credit default swaps from AIG. It was so much that Goldman realized that AIG itself might go bankrupt. So they spent $150 million insuring themselves against AIG's potential collapse. Then in 2007, Goldman went even further. They started selling CDOs specifically designed so that the more money their customers lost, the more money Goldman Sachs made.
$600 million Timberwolf securities is what you sold. Before you sold them, this is what your sales team were telling to each other. Boy, that Timberwolf was one shitty deal.
This was an email to me in late June.
Right, and you sold Timberwolf. No, you sold Timberwolf after as well.
We did trades after that.
Yeah, okay. The next email, take a look, July 107, tells the sales force the top priority is Timberwolf. Your top priority to sell is that shitty deal. If you have an adverse interest to your client, you have the duty to disclose that to your client, to tell that client of your adverse interest. That's my question.
Mr. Chairman, I'm just trying to understand.
No, I think you understand it. I don't think you want to answer. What do you think about selling securities which your own people think are crap? Does that bother you?
I think they would, again, as a hypothetical.
No, this is real.
Well, then I don't.
We heard it today.
Well,
we heard it today. This is a shitty deal. This is crap.
I heard nothing today that makes me think anything went wrong.
Is there not a conflict when you sell something to somebody and then are determined to bet against that same security and you don't disclose that to the person you're selling? You see a problem?
In the context of market making, that is not a conflict.
When you heard that your employees in these emails said, God, what a shitty deal. God, what a piece of crap. Do you feel anything?
I think that's very unfortunate to have on email.
Are you embarrassed?
And very unfortunate. I don't.
On email,
please don't take that.
How about feeling that way?
I think it's very unfortunate for anyone to have said that in any form.
The lawsuit alleges that Morgan Stanley knew that the CDOs were junk. Although they were rated AAA, Morgan Stanley was betting they would fail. A year later, Morgan Stanley had made hundreds of millions of dollars, while the investors had lost almost all of their money.
You would have thought that pension funds would have said, those are subprime. Why am I buying them? And they had these guys at Moody's and Standard & Poor's who said that's a AAA.
none of these securities got issued without the imprimatur, the good housekeeping seal of approval of the rating agencies.
The three rating agencies, Moody's, S&P, and Fitch, made billions of dollars giving high ratings to risky securities. Moody's, the largest rating agency, quadrupled its profits between 2000 and 2007.
Moody's and S&P get compensated based on putting out ratings reports, and the more structured securities they gave a AAA rating to, the higher their earnings were going to be for the quarter.
What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
Ben Bernanke became chairman of the Federal Reserve Board in February 2006, the top year for subprime lending. But despite numerous warnings, Bernanke and the Federal Reserve Board did nothing. As early as 2004, the FBI was already warning about an epidemic of mortgage fraud. They reported inflated appraisals, doctored loan documentation, and other fraudulent activity.
Going to keep growing, okay? And obviously, I'll say it: if you're growing, you're not in recession, right? I mean, we all know that. Nothing about our actions today in any way reflects a changed view of the housing correction or the strength of other U.S. financial institutions.
2 days later, Lehman Brothers announced record losses of $3.2 billion, and its stock collapsed. Paulson and Bernanke had not consulted with other governments and didn't understand the consequences of foreign bankruptcy laws.
Lehman Brothers London continued to empty their
Under British law, Lehman's London office had to be closed immediately.
All transactions came to a halt, and there are thousands and thousands and thousands of transactions.
The hedge funds who had had assets with Lehman in London discovered overnight, to their complete horror, that they couldn't get those assets back.
Lehman's failure also caused a collapse in the commercial paper market, which many companies depend on to pay for operating expenses such as payroll. That same week, AIG owed $13 billion to holders of credit default swaps, and it didn't have the money.
AIG was another hub. If AIG had stopped, all planes may have to be, stop flying.
On September 17th, AIG is taken over by the government. And 1 day later, Paulson and Bernanke asked Congress for $700 billion to bail out the banks.
Coming together.
They warned that the alternative would be a catastrophic financial collapse.
The hand that was dealt me, a lot of what I'm dealing with, I'm dealing with the consequences of things that were done often many years ago.
Secretary Paulson spoke throughout the fall and all the potential root causes of this, and there are plenty. He called them. So I'm not sure.
You're not being serious about that, are you?
I am being serious. What would you have expected? What were you looking for that you didn't see?
He was the senior advocate for prohibiting the regulation of credit default swaps and also lifting the leverage limits on the investment banks.
So again,
he mentioned those things? I never heard him mention those things.
Could we turn this off for a second?
When AIG was bailed out, the owners of its credit default swaps, the most prominent of which was Goldman Sachs, were paid $61 billion the next day. Paulson, Bernanke, and Tim Geithner forced AIG to pay 100 cents on the dollar rather than negotiate lower prices. Eventually, the AIG bailout cost taxpayers over $150 billion.
$160 billion went through AIG, $14 billion went to Goldman Sachs.
At the same time, Paulson and Geithner forced AIG to surrender its right to sue Goldman and the other banks for fraud.
Isn't there a problem when the person in charge of dealing with this crisis is the former CEO of Goldman Sachs, someone who had a major role in causing it?
Well, I think it's fair to say that the financial markets today are incredibly complicated.
The men who destroyed their own companies and plunged the world into crisis walked away from the wreckage with their fortunes intact. The top 5 executives at Lehman Brothers made over $1 billion between 2000 and 2007. And when the firm went bankrupt, they got to keep all the money. Stan O'Neill, the CEO of Merrill Lynch, received $90 million in 2006 and 2007 alone. After driving his firm into the ground, Merrill Lynch's board of directors allowed him to resign, and he collected $161 million in severance. In the U.S., the banks are now bigger, more powerful, and more concentrated than ever before. After the crisis, the financial industry is harder than ever to fight reform. The financial sector employs 3,000 lobbyists, more than 5 for each member of Congress. The financial industry also exerts its influence in a more subtle way, one that most Americans don't know about. It has corrupted the study of economics itself. Since the 1980s, academic economists have been major advocates of deregulation and played powerful roles in shaping U.S. government policy. Very few of these economic experts warned about the crisis. And even after the crisis, many of them opposed reform. Martin Feldstein is a professor at Harvard and one of the world's most prominent economists. As President Reagan's chief economic advisor, he was a major architect of deregulation. And from 1988 until 2009, he was on the board of directors of both AIG and AIG Financial Products, which paid him millions of dollars.
Do you have any regrets about having been on AIG's board?
I have no comments. No, I have no regrets about being on AIG's board.
Taught at Northwestern, Chicago, Harvard, and Columbia.
Glenn Hubbard is the dean of Columbia Business School and was the chairman of the Council of Economic Advisors under George W. Bush.
Do you think the financial services industry has too much political power in the United States?
I don't think so, no. You certainly wouldn't get that impression by the drubbing that they regularly get in Washington.
Were Ralph Ciaffi and Matthew Tannen, Bear Stearns hedge fund managers prosecuted for securities fraud. After hiring the analysis group, both were acquitted. Glenn Hubbard was paid $100,000 to testify in their defense.
Do you think that the economics discipline has a conflict of interest problem?
I'm not sure I know what you mean.
Do you think that a significant fraction of the economics discipline, number of economists, have financial conflicts of interest that in some way might call into question or color?
Oh, I see what you're saying. I doubt it. Most academic economists, aren't wealthy business people.
Hubbard makes $250,000 a year as a board member of MetLife and was formerly on the board of Capmark, a major commercial mortgage lender during the bubble, which went bankrupt in 2009. He has also advised Nomura Securities, KKR Financial Corporation, and many other financial firms. Larry Summers, who as Treasury Secretary played a critical role in the deregulation of derivatives, became president of Harvard in 2001. While at Harvard, he made millions consulting to hedge funds and millions more in speaking fees, much of it from investment banks.
Does Harvard require disclosures of financial conflict of interest in publications?
Not to my knowledge.
Do you require people to report the compensation they've received from outside activities?
No.
Don't you think that's a problem?
I don't see why.
Martin Feldstein being on the board of AIG, Laura Tyson going on the board of Morgan Stanley, Larry Summers making $10 million a year consulting to financial services firms. Irrelevant.
Yeah, basically irrelevant.
You've written a very large number of articles about a very wide array of subjects. You never saw fit to investigate the risks of unregulated credit default swaps?
I never did.
Same question with regard to executive compensation, the regulation of corporate governance, the effect of political contributions.
I don't know that I would have anything to add to those discussions.
I'm looking at your resume now. It looks to me as if the majority of your outside activities are consulting and directorship arrangements with the financial services industry. Would you not agree with that characterization?
No, to my knowledge, I don't think my consulting clients are even on my CV, so I don't know.
Who are your consulting clients?
I don't believe I have to discuss that with you.
Okay.
In fact, you have a few more minutes and the interview's over.
They include other financial services firms.
Possibly.
You don't remember?
This isn't a deposition, sir. I was polite enough to give you time. Foolishly, I now see. But you have 3 more minutes. Give it your best shot.
In 2004, at the height of the bubble, Glenn Hubbard co-authored a widely read paper with William C. Dudley, the chief economist of Goldman Sachs. In the paper, Hubbard praised credit derivatives and the securitization chain, stating that they had improved allocation of capital and were enhancing financial stability. He cited reduced volatility in the economy and stated that recessions had become less frequent and milder. Credit derivatives were protecting banks against losses and helping to distribute risk.
A medical researcher writes an article saying, to treat this disease, you should prescribe this drug. Turns out doctor makes 80% of personal income from manufacture of this drug. Does not bother you.
I think it's certainly important to disclose well, I think that's also a little different from cases that we're talking about here because
When I first came to office, I thought taxes were too high, and they were.
The most dramatic change was a series of tax cuts designed by Glenn Hubbard, who at the time was serving as President Bush's chief economic advisor. The Bush administration sharply reduced taxes on investment gains, stock dividends, and eliminated the estate tax.
We had a comprehensive plan that, when acted, has left nearly $1.1 trillion in the hands of American workers, families, investors, and small business owners.
Most of the benefits of these tax cuts went to the wealthiest 1% of Americans. For the first time in history, average Americans have less education and are less prosperous than their parents.
The era of greed and irresponsibility on Wall Street and in Washington has led us to a financial crisis as serious as any that we faced since the Great Depression.
When the financial crisis struck just before the 2008 election, Barack Obama pointed to Wall Street greed and regulatory failures as examples of the need for change in America.
A lack of oversight in Washington and on Wall Street is exactly what got us into this mess.
After taking office, President Obama spoke of the need to reform the financial industry.
We want a systemic risk regulator, increased capital requirements. We need a consumer financial protection agency. We need to change Wall Street's culture.
But when finally enacted in mid-2010, the administration's financial reforms were weak, and in some critical areas, including the rating agencies, lobbying, and compensation, nothing significant was even proposed.
There's very little reform.
How come?
It's a Wall Street government.
Obama chose Timothy Geithner as Treasury Secretary. Geithner was the president of the New York Federal Reserve during the crisis, and one of the key players in the decision to pay Goldman Sachs 100 cents on the dollar for its bets against mortgages. The new president of the New York Fed is William C. Dudley, the former chief economist of Goldman Sachs, whose paper with Glenn Hubbard praised derivatives. Both Martin Feldstein and Laura Tyson are members of Obama's Economic Recovery Advisory Board. And Obama's chief economic advisor is Larry Summers.
The most senior economic advisors are the very people who were there who built the structure.
The Obama administration resisted regulation of bank compensation, even as foreign leaders took action. In September of 2009, Christine Lagarde and the finance ministers of Sweden, the Netherlands, Luxembourg, Italy, Spain, and Germany called for the G20 nations, including the United States, to impose strict regulations on bank compensation. And in July of 2010, the European Parliament enacted those very regulations. The Obama administration had no response.
And that is why I am reappointing him to another term as chairman of the Federal Reserve. Thank you so much.
In 2009, Barack Obama reappointed Ben Bernanke.
Thank you, Mr. President.
As of mid-2010, not a single senior financial executive had been criminally prosecuted or even arrested. No special prosecutor had been appointed. Not a single financial firm had been prosecuted criminally for securities fraud or accounting fraud. The Obama administration has made no attempt to recover any of the compensation given to financial executives during the bubble. For decades, the American financial system was stable and safe. But then something changed. The financial industry turned its back on society, corrupted our political system, and plunged the world economy into crisis.
여러분, 놀랍죠? 그 미국의 정치, 그 금권 정치, 의 부패를 더 보고 싶다 하시는 분들은 시간이 되시면 영화 바이스, 영어로는 VICE, Vice President Dick Cheney에 대한 실화에 대한 영화거든요. 어떻게 이라크 전쟁을 일으켰는가? 그걸 보시고요. 이제 너무 골치 아프다. 나 이런 건 다 하니까 좀 좋은 거 좀 보고 싶다 하시는 분들은 저의 다음 영상을 기대해 주세요. 왜냐하면 지금 여기에 나오는 이런 류의 세력들이 지금 전 세계를 컨트롤하려고 디지털 커런시, 센트럴 뱅크 디지털 커런시를 통해서 이런 중앙은행들이 이런 지금 움직임 그 현금을 없애고 디지털 그 화폐, 자기네들 디지털 화폐를 밀기 위해서 지금 백신 여권을 이용한다. 그래서 백신 여권을 밀고 있다. 이런 설도 있는데요. 거기에 대한 해결점에 대해서 다음 영상을 만들어 보겠습니다. 여러분, 희망이 있습니다. 너무 우울해하지 마시고요. 그래도 현실과 문제점을 알아야지 우리가 해결책을 보일 수 있기 때문에 이런 영상 한번 만들어 봤습니다. 오늘도 좋은 하루 보내세요.